Hey everyone, Paul here, and in this video I want to talk to you about US Concrete. And I think this is an interesting company because this is a company that I could very easily see being worth $50 to $60 a share, and it's currently trading at less than 40. But when we look at this as well, so their sales were down in Q3. There was a much bigger story than that. They were able to control their variable costs to such an extent that their earnings per share actually increased by nearly 80%. So they went from last year in Q3 at 79 cents to this year at $1.42. And with some recent acquisitions, in fact, that are actually going to be contributing positively to cash flow. But another big reason why I actually think this company is going to be a really good investment is that when you look at the businesses that they are acquiring and what they are kind of trying to transition more into, they're trying to get into a particular segment that actually has margins, in the 40% or about 45% for them, whereas their concrete business is about a 12% EBITDA margin for them. So the business that they're looking to expand into is specifically going to be the aggregate market. So when you look at the aggregate products, it's a component for concrete that they're able to use. And so what they do is they can use the aggregate products to be able to create their own concrete, but then they can also sell those to third parties as well. And that's just going to be a higher margin business. So again, I think that's part of the excitement with them. And then lastly, and this is what I'm going to be able to use to say that we could easily get to $50 to $60 a share in valuation, is the fact that this is really like a cash cow company. I mean, they've been consistently generating strong cash flow. If you look at them over the last several years, they've been averaging about $4 and change of free cash flow. That's been higher in the last couple of years. And when I start saying that it'd be worth $50, I'm talking about it assuming that they only earn, let's say, $4 and change in free cash flow for the rest of their existence, and they never grow, they never improve that, which, as we've already talked about with the margin expansion in the aggregate segment. I feel like there's only reason to be more optimistic about this company going forward. And then, of course, they've also got, some tailwind here because about 20% of their revenue comes from the public works segment. So when we look at the Biden administration that's coming in, they're going to be, there's a lot of hope that they're going to have a pretty big infrastructure bill that's going to be put in place. And then that has the potential, again, with that 20% exposure for US Concrete, that has the potential to be a good tailwind for them as we kind of head into the next few years as well. And I think with that publicity, I think there's going to be more of a conversation about this company, and I think that could be one of the catalysts that could start driving this stock, again, to, let's say, the 50s or 60s, just getting more eyes on this. Because when you're a company that's worth less than $1 billion, like US Concrete is, part of the problem is that a lot of people, a lot of analysts, a lot of investors have just never heard of this company. So I think that the more they get out there, the more people realize that this company is generating the cash that it's generating. I think that there's going to be more interest in investing in US Concrete. Looking at some other highlights from Q3 2020, so their balance sheet is in a stronger position now than what it was at the end of 2019. So specifically, at the end of 2019, they had about $41 million cash on the balance sheet, and now they've got over $405 million. So they've got a lot more cash at their disposal. And part of that is, again, they're continuing to generate strong operating cash flow, but they also have been able to couple that with kind of some smart ways that they were going to take some higher interest debt and kind of get that refinanced at a lower rate. So they're saving money, fortifying their balance sheet, but they're in a strong position as of Q3 2020. And now I want to take you over to the investor relations website, and this is something I would want to encourage you to do for any stocks that you might want to buy. There's a lot of really good information on the investor relations websites, and public companies have to have this section. So specifically, this presentation is looking at an investor presentation that was put together on November 12th, 2020. So I'm filming this on November 28th, so this is still a pretty recent piece of information that we can take a look at. But the first slide I want to show you here, this is talking about their growth and their value proposition, and this is just exactly what I was telling you about, the fact that they want to continue to expand into a higher margin segment, which is specifically that aggregate market. So that's something the company is very aware of. So you can look at it historically and say, yes, they've been expanding that margin, they've been growing into that space, but that's something that they recognize as an opportunity for them to expand into even more. And then, of course, it's concrete. You don't think about concrete as being a technology-driven business, but they are still finding ways to be able to incorporate technology to be able to help help build their business. So they've got a tool called Where's My Concrete, which really just kind of shows their customers where their products are through the whole life cycle of the construction project. Now let's take a look, breakdown. I think this is pretty cool to be able to see where their different operations are. So they operate in 3 main regions. They operate in the West, the East, and then the Central region. And the West region really for this purpose is just going to be California. Central region is really just Texas. And the East has a few more state diversity, but it's primarily going to be around like the metro New York area. And what's also kind of nice about this is that they're split up pretty evenly. So it's about a third approximately, for each of these regions here. There's no one region that's just going to completely dominate. That's the good news. Part of the bad news is, of course, that 2 of the markets that have been hit the hardest as a result of COVID and shutdowns and things of that nature have been the metro New York area and have been California. And again, those are 2 of the biggest markets that they operate in. But as we've already said, the fact that they were able to still navigate that and still increase their earnings per share by the amount that they did and control their variable costs, I mean, that was a very good quarter for them and proof that they're going to be able to survive this, in my opinion, and come out stronger on the other side. So when we look at it as well, we can see their growth. So in 2011, they had 113 ready-mix concrete operating facilities. And then now current for Q3 2020, they're up to 192. They had 7 aggregate producing facilities in 2011. They've grown that now to 20. And they had 0 aggregate distribution terminals 9 years ago. And now current, they have 7 of these aggregate distribution terminals. So I think that's pretty strong. Okay, now in this slide, this is just going to show you a breakdown of where they're going to be getting their revenue by region and by market, and then their profitability by type as well. So again, we can see, just as we said in the last one, that by region, they're pretty evenly distributed between the West, the Central, and the East regions in terms of where they're earning their revenue. And then when we look at the ready-mixed volume by end market, we see that again close to about 20%. So this is based on the last 12 months with their ending in the most recent quarter. But 16% of the revenue went to infrastructure, 25% to residential, and then 59% to commercial and industrial. We look at their adjusted EBITDA for ready-mix concrete versus aggregates, and aggregates represented 33% of their adjusted EBITDA versus 67% for the concrete. And again, this is another example where you can see that higher margin with their aggregates business, because the aggregates business is it's about 15% of sales. So it'd be 15% of sales, but generating 33% of their adjusted profitability here. I mean, that really calls out that higher margin. And speaking of margin, so this is going to be a kind of an interesting breakdown as well. So when we look at the last 5 years, their compound annual growth rate in terms of their revenue and their adjusted EBITDA have been both growing strongly. So revenue has been growing by over 9%, and then their adjusted EBITDA has actually been growing over 10%. So we continue to see that margin expansion driven in part from their shift more into the aggregates market, right? So we're seeing this in the historical data. We see it in a much bigger extent in the last 10 years, definitely. So in the last 10 years, they've been able to grow their revenue by over 12%. They've been able to grow their adjusted EBITDA by over 48%. So those are really impressive numbers there. And then we look to the right of this, we see a breakdown comparing US Concrete in terms of their aggregates margin and their ready-mix concrete margin compared to some key competitors here. So we see that, again, US Concrete, they've been able to achieve about a 45.9% margin with their aggregate business and 12.5% with the ready-mix concrete. And that's still higher on both accounts compared to their competitors. And we can even see with their competitors, of course, that trend is holding as well, that their aggregate margin is higher than what their ready-mix concrete is. Here we can kind of get into some more trends as well. So we can go ahead and take a look at some of the revenue trends that have been going on and some of their adjusted free cash flow, because as I mentioned, this is a very strong company in terms of generating free cash flow. So when we look at the revenue, it had been trending higher from 2015 to 2018. It had gone down slightly in 2019, and then for the last 12 months, there's been that headwind as well. But still, if you look at the last 12 months compared to what 2019 in total was able to accomplish, there wasn't that much of a loss there. But at the same time, again, by controlling those variable costs, their adjusted free cash flow has actually been much higher in the last 12 months than what it has been from any year prior to that. So they generated $163 million of adjusted free cash flow for the last 12 months with the quarter ending 9/30. And again, that's higher than any previous period. And what's interesting is that even if you were going to just take a look at the average free cash flow from 2015 to 2019, you're going to take an average of that per share. That's what I was talking about, that even that amount, if that was going to be sustained with no growth whatsoever, you could start talking about this company easily being worth about $50 a share. Now, if you were going to start talking about them being able to sustain the 163 million, like let's say that's maybe the new normal, which I'm not necessarily saying that it is, but if it was, I mean, you could easily start talking about this company being in the 60s in terms of what their valuation could be. So I think that that's quite interesting as well. Then we can take a look at their capital expenditures. They've really kind of kept those under control, and most recently you can tell that again they've kind of scaled back on that as a response to trying to conserve some cash. And finally, what I want to do here is I want to walk through how I was telling you earlier, I think that this could be worth $50 a share based on certain assumptions, or $60. What I want to do here is just kind of walk through and say, here's what I'm basing that on. Here's the methodology. So I've laid out the free cash flow per share from 2014 to 2019, and these are known numbers. And for the most part, they're kind of increasing. They're not negative, which is also key. So they're not burning cash in any of these years from 2014 to 2019. But really, from 2017 to 2020, they have consistently been increasing their free cash flow. We don't know 2020's full numbers yet, but they've been trending higher. But even from 2017 to 2019, where we do know these exact numbers, they went from $3.14 to $4.85 to $5.86 of free cash flow per share. Okay, so we're seeing that growth. So there's some different things that we can do here. We can say, well, okay, what if the most recent $5.86, what if they were able to achieve that every year? They don't grow at all, so they're not going to, the trend has been that they've been increasing their free cash flow. They're not going to do that. They're just going to hold steady. Well, okay, then we can, scroll over here. We can see all these future years. All we have is $5.86, okay? But then what we can do is there's this formula in Excel. Which is equals PV, which is just present value. And that's going to say that it's going to take into account the time value of money. Because we need to say that if you're earning $5.86 in free cash flow in the year, 2100, that's not as valuable as if you're going to be earning it today. Okay, and so a dollar earned today is going to be more valuable than a dollar next year or the year after, and so on. Okay, so we need to take into account that each successive dollar that this company is generating in the future is going to be worth less than what it's able to generate today. And you do that by using this present value formula. And what you do is you plug in what the interest rate is, you plug in what the period is. So if it's 1 year out, 2 years out, things of that nature. So for each progressive year out, we're increasing this by another year. And then we're able to kind of arrive back to a discounted number based on the interest rate that we're choosing. So if we're discounting these future cash flows at a rate of 9% in Excel here, we can say that $5.86 in a year from now is only worth $5.38 today. And then that amount in 2 years is worth $4.93 today. And so this amount gets lower and lower as we move through the years, okay? And that's saying that because, again, as we move further out in time, it's becoming less valuable to us. So what we can do is just add up all of those discounted cash flows. And in this example, that actually adds up to $65.09, which all that means is that if this company was able to still generate $5.86 of free cash flow for the rest of their life as a company, if they were able to achieve that, they'd be worth about $65 a share. And again, they're currently worth about $37 a share. Now, you might say, well, $5.86 was the best, full year of cash flow this company has ever reported. Is it realistic that they're going to hit that every single year consistently? maybe it's not, okay? At the same time, we weren't expecting any growth as well, so I think that's another offsetting piece to make that assumption a little bit more conservative, but let's say you don't think that's realistic. Let's say what you think is realistic is that this company is going to earn what it earned in 2018, when it earned $4.85 of free cash flow. Well, let's take a look at that. What if it earned its second best year free cash flow, and it earned that with no growth for the rest of its life, okay? We would follow the same process with that present value formula. Okay, so we see that here, got our present value, still discounting it by 9%. And in that particular case, it'd be worth $53. Well, let's take a look at one last scenario, okay? One last scenario, let's say that, it's too aggressive to pick any one year, especially when the last couple of years have been really good for the company in terms of cash flow. Let's say that we want to instead take an average of the past from 2014 to 2019. So in the past year, we're seeing the cash flow range anywhere from $1.32 all the way up to $5.86. And that average then comes out to $4.25. So let's say that we're able to achieve that for the whole life of the company. And if we do that, we come back to a valuation of $47.15. So I think even with some pretty conservative assumptions and assuming that there's no growth in this company, okay, assuming that there's really going to not be any positivity from their margin expansion from getting into that or more involved in the aggregate segment like they already are, there's no positivity there, you start to get to a pretty conservative valuation for this company, saying that this is actually a pretty good buy. So for me, I'm going to be looking for some weakness to buy into this. I would really like to buy in the mid to low 30s. I feel like I don't want to chase because it's kind of run up a little bit lately. But this is absolutely the kind of company that I'm interested in buying into. I want to buy into something that's kind of more under the radar, a smaller company, a company that is generating a lot of cash relative to the size of the business. So I think there's a lot to be excited about with US Concrete, which is as crazy as that sounds. I mean, a concrete company, I know everybody gets so fired up about Tesla stock and NEO and all these things, but sometimes it can be these really steady companies that are generating some really strong cash flow that can lead to really long-term steady success. So love to know what you guys think about this company. If this is something you are investing in, love to know your thoughts. Let me know in the comments below, and I'll see you next video.